Most people are asking the wrong question right now. They keep asking, what stocks should I buy today? But the smarter question is, what stocks will I wish I bought when fear was high and prices were low? Because the biggest money in the stock market is never made when everyone feels confident. It's made when sentiment is broken, when headlines look scary, and when most people are too emotional to act. Today, I'm going to share the exact mindset, logic, and stock ideas I'm personally watching right now. No fancy intro, no hype, just real talk. And if you stay with me until the end, you'll understand why moments like this quietly create life-changing opportunities. Before we begin, quick favor. If you want honest, long-term stock ideas without clickbait, hit like, subscribe to Stockora, and share this video with someone who actually cares about investing. It really helps the channel, and it tells me you want more content like this. Now let's get into it. This morning, Meta stock jumped, while Microsoft dropped hard. Same market, same AI theme, completely opposite reactions. Why? Both companies reported massive AI spending. Meta is planning well over $100 billion in AI infrastructure. Microsoft? Roughly the same, possibly even more. Two companies alone spending over $200 billion on AI. That should tell you one thing very clearly. AI isn't slowing down. It's accelerating. And if that's true, then the companies building and controlling the AI backbone still have room to grow. So why did the market reward Meta and punish Microsoft? It comes down to sentiment. Meta is being seen as proving AI success. Microsoft is being questioned. People are suddenly nervous about software. They're scared that AI will replace software instead of powering it. But that fear is misplaced. Here's what most people get wrong about AI. They think AI is just chatbots, AI videos, or random content on social media. That's not where the real money is. The real money is enterprise AI. Businesses don't care about viral content. They care about automation, security, data control, efficiency, and scale. And that's exactly why companies like Microsoft, ServiceNow, and cybersecurity platforms exist. AI doesn't kill enterprise software. It makes it more necessary. And history backs this up. In 2022, most investors completely missed the opportunity in data center infrastructure. While fear was high, companies like Nvidia and AMD were quietly setting up one of the greatest runs in market history. The market was wrong then, and it's very likely wrong again now. Which brings us to the first stock, ServiceNow. This is a company the market is aggressively throwing away right now, and that's exactly why it deserves attention. ServiceNow just reported earnings. They beat expectations. Revenue grew over 20% year over year. Remaining performance obligations jumped more than 26%. That's not a weak business. They also announced another multi-billion-dollar share buyback. And on top of that, the CEO personally bought $20 million worth of stock. Executives don't do that unless they believe the stock is undervalued. Yet the stock sold off hard. Why? Because the market is dumping anything labeled software. And when the market acts emotionally, opportunity is created. There's a lot of noise online saying ServiceNow is legacy software. That's simply wrong. Legacy software is on-premise, outdated systems. ServiceNow was built for the cloud, designed to replace legacy systems. It's modern, scalable, and deeply embedded into enterprise workflows. More importantly, it's positioning itself as an AI control layer. As AI agents begin acting autonomously across companies, businesses will need a way to manage, secure, and control them. That's exactly what ServiceNow is building. Yes, the stock can go lower. Nothing moves in a straight line. But long-term investing is not about perfection. It's about conviction. Almost every massive winner looks ugly before it becomes beautiful. Nvidia was once down 30% before becoming a multi-thousand% winner. Palantir dropped over 40% before exploding higher. Temporary pain is often the price of extraordinary returns. Right now, ServiceNow is trading near levels that historically reward patience. This isn't about day trading. This is about building a position over time while sentiment is broken. And that brings us to something important. Not everyone wants software stocks. So let's talk energy. Because AI doesn't run on hope, it runs on power. Data centers need massive amounts of energy, and nuclear is quietly becoming a critical solution. Constellation Energy is the largest nuclear power operator in the United States. It provides clean, carbon-free energy to millions of homes. Is it cheap? No, but great businesses rarely are. The reason investors care about Constellation is positioning. Nuclear energy is one of the few scalable solutions capable of supporting AI growth. After a massive run, the stock pulled back nearly 50% from its highs. That's not random. Strong stocks often retrace halfway before stabilizing, and right now, Constellation is sitting exactly in that zone. Same story with Vistra, another major power producer, diverse energy mix, strong cash flow. It followed nearly the same pattern. Huge run, deep pullback, now sitting near historically attractive levels. These aren't momentum trades. They're long-term infrastructure plays tied to AI demand. If AI continues expanding, power demand will follow, and these companies are positioned for that future. Now let's return to Microsoft, because this is where things get really interesting. Microsoft delivered strong earnings. Cloud revenue surpassed $50 billion. AI adoption is accelerating across enterprises, yet the stock sold off. Why? Because traders saw slight deceleration in Azure growth and panicked. But slowing growth at massive scale is normal. You can't grow exponentially forever. Microsoft isn't losing relevance. It's expanding infrastructure for the next decade. This sell-off has pushed the stock below key long-term averages. Historically, those moments have offered excellent long-term entries. Could it go lower? Absolutely. But risk and reward are finally shifting back in favor of patient investors. And that's the key theme of this entire video. Opportunity doesn't come when everything feels good. It comes when confidence is shaken. In the next part, I'm going to move fast and cover several additional stocks: cybersecurity, data, AI platforms, and even one high-risk speculative idea. These are not recommendations. They're ideas to research, understand, and watch closely. So if you've made it this far, do me a favor. Comment Stockora below so I know you're still with me. Share this video with one investor who needs a clearer perspective right now. Let's continue. Now let's go rapid fire. These next names are for investors who already understand the fundamentals and are looking for better entries, not hype. Axon is one of those companies. This stock ran way too far, way too fast, and that created an air pocket. Air pockets always fill eventually. After pulling back sharply, Axon is finally approaching levels where risk and reward start to balance again. It's still a premium business, but price matters. Buying strength after consolidation beats chasing highs every single time. Salesforce is another example. Growth has slowed. That's not a surprise. But the business is stable, profitable, and deeply embedded in enterprise operations. When stocks like this are treated as dead money, long-term investors should pay attention. Oracle is similar. After an extended rally, the stock became overpriced. Now it's correcting. As it approaches long-term support levels, it becomes interesting again. Not exciting, but reliable. Cybersecurity deserves special attention. As AI grows, security risks multiply. That's why companies like Palo Alto remain critical. After a strong run, it's now back near accumulation zones. Rubrik is another name to watch. Newer, more volatile, higher risk. But data protection is becoming non-negotiable. For investors willing to accept volatility, these pullbacks can offer asymmetric upside. Snowflake falls into the data category. It's not traditional software. It's consumption-based. That makes it more flexible in an AI-driven world. After a massive rally and pullback, it's now consolidating again. This is what healthy stocks do before the next move. There is also one speculative idea. Very high risk, very high reward. This is not for everyone. Small cap AI infrastructure plays can swing violently. If you don't understand volatility, avoid them. But for experienced investors, these are the kinds of positions that can surprise to the upside. And finally, Netflix. This isn't about hype, it's about price. After a strong run, the stock pulled back sharply. Now it's approaching levels where long-term risk starts to shrink. Strong brand, global reach, improving margins. When quality businesses correct, investors should pay attention. Let me leave you with this. The market doesn't reward comfort. It rewards discipline. Most people buy when stories sound good and prices are high. Then they sell when fear takes over. Great investors do the opposite. They buy slowly, patiently, and with conviction when others hesitate. If this video helped you think differently, hit like, subscribe to Stockora, and share it with someone who needs clarity instead of noise. Drop a comment below and tell me which stock you're watching right now. I'll see you in the next one. Comment Stockora below so I know you're still with me. Share this video with one investor who needs a clearer perspective right now. Let's continue.